our feature presentation.
All righty. You want to mute the mic on there? All right. Hello, everybody. Welcome back to the Wealth Management Advisory Club meeting. Today, we have Mark Menard from Grant Thornton come and speak to us today. I'm just going to read a little bit about him, and then we were going to pass it off to him. Again, for everyone who is coming in person, if you do come in person, ask a question, you'll be able to receive a free Grant Thornton cup. And if you do come in person, obviously a Metro Forum, you'll be able to be entered in a raffle to win a free Grant Thornton t-shirt. So just throwing that out there for anyone who's watching this. You know, it's your last chance to come in person and get these awesome gifts. All right, so with that being said, I'm just going to introduce our speaker, then we will get this going. Let me just, let me show them in here. All right, so Mark Menard is a tax service partner and leads the private wealth services practice in the Metro NY New England area for Grant Thornton. He received his bachelor's degree in accounting from the University of Connecticut. He has extensive experience with tax and financial matters affecting high net worth individuals, trusts, and closely held businesses. His area of expertise includes income tax planning and compliance, cash flow analysis, gift and estate planning, and wealth transfer and succession planning. Mark's primary clients consist of family offices, private equity and hedge funds principals, private and public company executives, and venture capital investors. Mark has over 15 years of combined public and private accounting experience. Prior to joining Grant Thornton, Mark was the vice president at KKR Financial Services Company, where he performed tax planning and family office services for a single family client. Prior to that, Mark was a senior manager at a large public accounting firm. Fun fact about Mark, he's a member of the AICPA and is also a CPA as well. So again, guys, please ask a lot of questions. Again, if you are on the Metro campus in person and forum, if you have a question, just please let me know. I'll write your name down, give you the cup. And then, yeah, so with that being said, Mark, I'll let you take it away from here.
Thank you very much. May just be my view, but the gallery, with this, I won't be able to see attendees or know how many people I'm speaking to.
I'll be able to see them. Okay,
because right now I'm just talking to myself, but I'll pretend that.
These members come late, so you know they have a tendency to do that. So don't worry, they'll be coming file it in the masses.
Got it.
In some way.
Okay.
So, yeah.
Is it worth holding off?
Yeah. So we record these things obviously put on our YouTube channel, so wherever members are going to make it. You basically put them up on there, and they can watch the meeting. The way for them to say, hey, you can't make the meeting, you have a class, you know, you can watch it here. So you don't miss that.
All right. Well, then, thank you for the introduction. What I'll do is I'll share my screen. I've got some slides that are some of our stock slides from our campus recruiting that'll help to give an overview of Grant Thornton, and then, you know, make it a little more specific to what I do and how it relates to investment management advisory. And please interrupt, ask questions. The more collaborative, the better. Right. I'll fumble around one. It's hard to do this without a mouse. All right. So start with an overview of Grant Thornton. Grant Thornton, it's tax audit advisory firm. We are, you know, what we like to call middle market focused. You know, sometimes obviously you all know about the big four and who they are, and we're in that second tier of revenues and size. And you know, as you'll see here, about $6.5 billion 2021 revenues, 2.8 billion of which was United States revenue. And we serve the middle market, which is our primary target is companies with revenues of about 100 million to 2 billion annual revenue. So very big companies, typically privately owned, which as we get into the presentation is really good for me because it allows me to work with a lot of these companies. We still do work with SEC companies. We just don't have the capacity to do the audit for a Coca-Cola or a Ford Motor. So that's where our business model differs from some of the big four. And while we're smaller in revenue, it's a slightly different business, which we're happy playing in this space. So as you see here, we do have global presence, and we are one united global Grant Thornton. Sometimes you see in the mid-market firms where there are alliances and referral networks within a firm. But Grant Thornton United States, Grant Thornton UK, we are truly one firm that interact and have the same branding, same values, same mission statements. So it's a very, very large organization. What do we do? Audit tax advisory. Audit's pretty straightforward. As I mentioned, we really focus on that middle market. So a lot of these are privately held companies, and we do some public audits. I don't know the exact breakdown between the two, but it's heavily favored towards those privately held. Tax, that's the space I work in. Specifically, I work in private wealth tax. But within tax, there are endless subsets. There's business tax, state and local, international. So very, very general category tax and a lot underneath it. And then advisory is another really broad concept. Our advisory ranges from compliance, going in and helping with internal audit functions, outsource CFO functions, whether it be data security. Advisory is a very fast growing, as it is at most firms right now. It's a very dynamic space that people work in, and a lot of different competencies underneath advisory. So being a CPA firm, generally for audit and tax, the path to partner principal is generally CPA, sometimes JD. Advisory is a little bit more broad, and depending on the specialty, you don't necessarily have to be an accounting major to find a fit advisory. This is, the slides I'm stealing here are a lot of it from our campus recruiting. So I will hit very briefly on our core values because it is important. And I think we do see it, and we do see responsiveness to our values. And I think the number one way to judge that is on our attrition, and which is incredibly low, especially recently. The pandemic was funny for everyone, with a lot of job hopping and people doing some soul searching on what they want to do with their lives. But for the last year and a half, it's been incredible to see how static it is, which, from someone who's a leader of the firm, it's great from a business continuity, but even better, it shows that our people are happy. So great firm. And, if anyone has any questions about the firm or opportunities at the firm, that's a separate conversation from here, but one I'd love to have with anyone who's interested. So I'll skip through some of these. I'm happy to share these slides afterwards if anyone's interested, but I don't think it's appropriate to really dive into our audit solutions here. Tax solutions, this is a little whittled down, but I think it's a nice lead in to at least show private wealth services, a couple bullets of what we do. And some of the consultative things, because at the end of the day, we do tax returns. And tax returns for high net worth people, it's part of the job. But I really look at it as the reporting of the planning you've done throughout the year. So you're doing tax returns, it's a means to an end. It's something you need to do, but you're not solving anyone's problem on April 14th when you're filing their tax return. You're solving problems throughout the year by having an active relationship, getting to know your client, what's important to them, and really bringing some creativity to the table and interacting with both the client and their other advisors. So some of the key consultative areas that we work in business succession and transfer planning. That's really the biggest piece here. And I'll keep coming back to that, dealing with private companies, especially when it's first generation. And when you talk about worth, it's very easy to think someone's net worth is tied to their investments, their stock portfolio, or how much cash they have in the bank. But I would say, I don't want to make up statistics here, but I will. I'll say, 90% of someone's wealth could be in their privately held business with very little liquidity outside of that. And there comes a point in everyone's time where you have to make a decision. You're either going to sell your business, you're going to take it public and monetize it some way that way. You're going to, give it to the employees, or you're going to give it to your heirs. And every one of those has significant tax consequences. And the last thing we want to see clients do is simply dive with $100 million company and pay estate tax and potentially have to sell the business because they didn't do proper planning. So that first point is something that's just very important and something that I'll come back to and touch on later. Income, trust, estate consulting, and compliance. Similarly, but same principle, there's two types of taxes we worry about. We worry about income tax. So that's something that you can kind of manage from year to year to some extent. But then there's the estate tax, which, everybody has your lifetime exemption. Right now it's just about $13 million. So you can die with $13 million of assets. Any dollar above that, the IRS is going to take 40%. And some states also take a cut. So when you think about $100 million estate, you get that $13 million haircut, but you're still left with $87 million that, do the math correctly, $87 million that 40% of that is going to the government if you do nothing else. So throughout someone's life, there's a lot of touch points and key points of time where you really need to review your estate plan. And that's part of our job, is to identify, by reviewing someone's personal balance sheet, significant life and business events, and, do some modeling and let them know this is what happens now if you do nothing. Here are some creative solutions that you can take. Family office services, as you get up into that, I think the general standard is that anyone with net worth over $500 million is when you start seeing that single family office. And those family offices, they really operate as their own little fund and company. And there's a lot of back office type work that they just aren't equipped to do, or they don't want to hire their own staff. So that's where a firm like ours can come in and really take a lot of the, whether it be, I guess, a back office type, doing their compliance, tax return work, or even helping with that structuring of setting it up from the beginning. Because a lot of times people will want to bring in a key investment person who's going to be actually managing the money for the people. But there's a lot of other things that a family office needs to do that can be very costly if you don't do it correctly. So that's where we can come in to make sure that the family is taken care of. And then wealth preservation. I think this one is a pretty broad statement, but it touches on everything. And our role in wealth preservation is, when you boil it down, it's pretty simple. It's making sure that you're doing everything within the boundaries of the law to make sure that you're not overpaying tax and putting your family's legacy at jeopardy. And the specialty tax services, some of these just, for education purposes that you don't normally think about when you think of it's either business tax or personal tax. Human capital services, that's a very interesting practice in our tax group. That is helping companies when they have employees shifting throughout the world and moving from one jurisdiction to another, avoiding double taxation in different countries, making sure that payroll is done correctly. So that's if you're interested in really dealing globally and getting to know people all over Asia and Europe, that's a very interesting practice. Mergers and acquisition, that's something that for the last 2 years has been incredibly hot, cooling off a little bit now with the economy, but with every transaction, buying and selling a business, there is a lot of tax implications. And our role in that is to help make it as efficient either from the buyer's perspective or the seller's perspective. then not-for-profit tax services, doing the work for an organization like Fairleigh Dickinson. We do a lot of universities, medical not-for-profits, doing their consulting and tax advising. And then again, advisory. I am happy to share this slide after. This is a very busy slide showing all the many things that you can do under the advisory umbrella. And there is overlap with all of that. I will consult with advisory if a family office needs help implementing a GL system. So there's a lot of cross between Grant Thornton solutions, and there's also a lot of cross between, now as we get into wealth management, how I deal with other advisors to the families and individuals I work with. So I deal very heavily with attorneys. It'll be trust and estate attorneys. It'll be business attorneys. Because at the end of the day, Grant Thornton is a CPA firm, which allows us the ability to give tax and audit opinions. You'll often see investment advisors are very clear that I am not giving tax advice. I am telling you some general thoughts on why this may be advantageous. But there's always a lot of disclaimers. We'll be the ones to make the tax decisions and opinions, and vice versa. I can speak with a client and say, it really makes sense for you to be in muni bonds right now, or stocks, or this, that. However, I am not an investment advisor. I disclaim. And then from an attorney standpoint, an attorney oftentimes aren't going to do the tax modeling for a plan, but they're the ones that will write the trust documents and sign everything together. So no matter what path you go down in wealth management, whether it be as an investment advisor, a tax advisor, a lawyer, the important thing is that nobody does it on their own. There are some small boutiques where they may have one-stop shopping, but really the best relationships and most successful engagements I've been a part of is when you have really good input from all the different areas and the family. Because at the end of the day, what the family wants to accomplish drives a lot. So here's just a couple bullets I put together to just help guide me through what is it we do in private wealth services tax. And private wealth services tax, at its core, I deal with individuals, trust, and estate. And at Grant Thornton, when we say individuals, it's really the high net worth individual space. We don't really consider ourselves a high volume tax compliance. We would rather have bigger, more sophisticated clients that have the complex issues that really warrant our expertise. So what do? We do tax structuring for business ownership and succession. I mentioned that earlier. That's really a core competency, and what really gets us our foot in the door to meet a lot of these clients is maybe we did an audit for their company, or we did the tax for the business. And it's a point in contact for us to say, how can we help you take this a step further and make sure that holistically you're optimizing your taxes? There's also after-tax optimization of investment returns. And I think that's kind of your most classic, what you think of. Am I harvesting losses at the end of the year to make sure that I'm not paying too much capital gains tax? Am I invested in a different state's municipal bonds for some reason where now I'm paying tax in my state when I don't need to? How am I holding this investment? Should I create a partnership with a couple of friends, or me as husband and wife? What are the implications? Because every one of these decisions, when you're setting an investment up, has big implications down the road. And some things are very easy to fix and unwind. Some things are very hard to fix and unwind. If you said today, my friend and I are going to set up an LLC and set it up as a corporation, and we're going to do investments. That might work great today, but in 2 years, when you try to change that and you say, I want to take money out of this business, you might have a world of problems that you didn't think about when you were setting it up. So all these decisions and touch point, it's our job to really get in on the ground floor, make sure we're having conversations and advising for the long term. And then building a family legacy and governance. The family legacy is really, whether it be keeping the money, maybe you're charitable and you want to start a private foundation, maybe you're you want to be charitable at your ultimate demise, but during your life, you want to live as lavishly as you want. There are ways to direct things at death that are tax efficient. And governance, this is often a legal aspect of it, but it involves us as well as, I want to live as much to my children as possible, but I don't want my children to be complacent. So how can I put safeguards in place? Is that a trust? Who do I choose as trustee to administer this? How do I want my children to live their life? And how do I want to maintain control from the grave is sometimes the thought process here. So, and, I left out, it's not the glorious thing, especially thinking about it on April 20th, when we just got through a filing season. But yes, their tax compliance is certainly part of it. And I don't want to diminish any value we add when we do tax returns, but I'm a firm believer that if you do the right planning, a tax return is simply reporting your income for the year and your deductions. If you've created those opportunities correctly, then the tax return is really just, checking a box. And who do we partner with? Investment advisors. At Grant Thornton in particular, we have relationships with a couple of the major banks. Morgan Stanley, we're one of their 5 providers that they recommend to their investment advisors. We also have relationships with Raymond James. And then as I've gone through my career, I've made relationships with a lot of bankers that you really a lot of times meet them through your clients, and you keep an open mind. And sometimes the biggest name bank doesn't necessarily mean the best advisor, and vice versa. And I think my takeaway there is there's just a lot of different directions to go to. There are family offices who act as their own RIA, and they're making investments and doing very well. Some people just like the name brand of a Goldman Sachs or a Morgan Stanley. But I'd say they all have their different models, different pluses and minuses, but I've encountered great advisors at all of them. And, having that relationship with an advisor who knows you, that can shoot you an email and say, hey, just crossing T's, dotting I's before I put my client in this investment, do you see any issues? They're not going to do that for every stock they pick, but with alternative investments that may have what we call phantom income and opportunities, cash flow difficulties, it's important to have that communication. Attorneys, trust and estate, business attorneys, that's really where you kind of get your foot in the door when the deal is going to happen, because an attorney is usually the first person contacted when someone's getting ready to sell their business. They want to keep it kind of close to their chest. They want to keep it confidential. Once the attorneys are involved, having those relationships where they know to call Grant Thornton because we can, help. They know we're competent and we can do a good job. That's a great source of connection for us. And then the closely held businesses. Don't need to harp into that again. So who are our clients? And typically we deal with the high net worth individuals, and there's all different kinds of definitions. I think you can read articles that say high net worth means you have $2 million liquid asset, and that's great. And then maybe what I have here is ultra high net worth. But the key differentiator here is that 26 million, because 26 million, that's 2 of those lifetime exclusions that I mentioned. So a husband and wife can pass away, and if they have 26 million or less right now, they don't really have estate issues. They don't even have to file an estate tax return. Their money can pass to their heirs. Their heirs get a basis step up, and everyone kind of goes on, and that everyone's happy. Well, as happy as you can be. One thing to note, in 2026, this number gets cut in half. So that's a big opportunity for us in the tax world to do a lot more planning for our clients. But the key thing with that number is that tells me that, that number could be someone has $50 in their checking account and a business worth $50 million. And if that's the case, there's a lot of planning that needs to be done, because what happens there? Somebody dies with $50 million. There's a big estate tax bill. There's no cash to pay that. And you either have to solve that with life insurance, or you have to sell that business. And then you've got a family that's generally not happy. So having those high net worth, high problem clients is really where we get to dig our hands in and make it a meaningful relationship for both times. Owners of closely held business for all those same reasons. Family offices, I think that's something that probably in the past decade and is even more common is just the opening of family offices, and also third parties who act as multifamily offices. So it's becoming more and more common for people to have their own teams that are handling a lot of their day-to-day. And every family office is very different. I worked at a family office for a multi-billion-dollar family that had a very robust infrastructure and basically unlimited resources. So it was operating almost like its own consulting firm within a building. In my role at Grant Thornton, I deal with some family offices where it's a really, really great investment manager, but someone who will openly say, I'm just here to make money. I don't know anything about tax. I don't know anything about financial statements for bank covenants. Can you help us with that? So unlimited ways that you can help a family office. And then just being the location we're at, hedge fund and private equity principles is really what makes up the rest of our business. So I probably out of this audience have the least experience in when we talk about investment for stocks and bonds. That's something that I don't claim to be an expert in. I personally invest in mutual funds and keep it quite simple. Where I see a lot more is in the private equity hedge fund investment space. And again, it's not saying that I source deals, but just an understanding of the goals, the strategies, and most importantly for me, the tax implications. So that's in a nutshell of what I do and of what Grant Thornton is. I think it's, as you think about investment management, wealth management, I know, we were talking before this, there's just endless, or just different backgrounds to lead to that. You can be a poli-sci major and decide you want to be a financial advisor. That's perfectly fine. And there's also multiple paths to go down where you can still help people and affect their wealth. And tax and high net worth space just happens to be the path that I went down. And I find it to be very fulfilling and, people are very appreciative and like dealing with you. And, when you can simplify something that's very complicated and also shows some really bottom line savings, you always get a good response. So that was my prepared remarks. I'm happy to make this more interactive now, and to the extent you had any loaded questions or if there's anyone that wants to ask.
Yeah. So like I mentioned earlier, we do have some student athletes in the club that are not the main things. Student athlete requirements that they do with, but they did ask me, they gave me like a list of questions to ask you. And I'm just going to go through that first, and then when we're done with that, obviously we will open it up to everyone on Zoom and anyone who wants to question a good person. We'll report this question. So the first question comes from Nick. Could you please share with us the most common mistakes investors make when managing their wealth, and how can they avoid them?
Yeah, I'll have to answer that from a tax perspective. So you take that for what it's worth. Most common, I would say for the general population, it would be making a rash decision before finding out the tax consequences, especially when you get into non-traditional investments, because what your gut tells you is often very different than what the reality is. For example, I don't like being in this hedge fund anymore. I'm going to redeem out of it. I just got my money back and this shouldn't be taxable. But, maybe there's some factors that have happened over the year, which you now don't have tax bases. And this is a big taxable transaction. I think, not consulting the right people is before making a decision. And then the entity selection. I think a lot of people will jump and say, I'm going to create an LLC. I'm going to make it an S Corp because I heard S Corps are really great. And not realizing that, wait a minute, if I have an S Corp, I need to treat everyone the same. And I can't have a one partner who's getting better treatment than another. So just making sure that what road you want to follow, or where you want, to follow the right road to get to the destination that you truly want to be, and not make rash decisions.
So next question comes from Vincent. In the current global economic climate, what are some key factors to consider when diversifying an investment portfolio?
I can say what I see now. I see a lot of clients moving to treasuries. I think a lot of people are being very defensive. And I think, the clients who I think are the most successful over time from a sheer investment perspective, not necessarily, business growth or, hitting home runs, are the ones that just have kind of stayed the course. I see a lot of people selling shares of stock that they've held for 20 years at ridiculously high gains, and you double check, you say, wait, how could they have bought shares of the, Coca-Cola for $7? And you look, they held it for a long time. There's something to be said for buy and hold, and being patient.
Yeah. So the next question comes from Caitlin. How have the recent changes in tax law and regulations impacted wealth management strategies, and what should investors be mindful of in the next coming years? So I do know, coming from me, where I've actually inserted tax verification, and with like the tax law is always changing. I'm actually currently taking a tax class right now. I'm funny enough. The professor who actually had you on worked with them, so I was like, wow, strange coincidence that would happen. But if you could talk about that.
Yeah, and there's tax changes. There have been a lot from, the Tax Cuts Jobs Act and the CARES Act. What's even more common is green books and discussions about what could change. And then you get ideas thrown out there like a wealth tax. And last year it was a 5% surcharge on people making over, I think it was $25 million a year. So there's always panic driven by, headlines, especially in the Twitter world, where someone will tweet out, we need a wealth tax for everyone over this. And tomorrow, and everyone starts calling, what do I need to do to be defensive? But to actually answer what has happened recently, I mean, there were changes with Trump's tax law changes that significantly impacted people. That was with the ability to deduct state and local taxes, getting less of a mortgage limitation. A lot of these things that people relied on, especially in high tax states, to offset some of their income, whether it be investment or not investment. So there's some workarounds that have been developed over the last few years to get around some of these rule changes to the extent you can. The government often likes to challenge different trust structures that are commonly used for people to move money out of their state to their children. So, and we've gone on a bit of a tangent. I don't want to miss the punchline of the question. Is it what am I seeing people do now because of tax changes? Is that the punch of it? Yeah, I think it's always going to be defer as long as you can and try to kick the can down the road. I think people aren't as worried right now that interest rates are going up. So it's really just, trying not to be reactive to every little news snippet that comes out.
Yeah. So next question comes from Sergio. I'll give you a good question now. So I'll actually add on to this question as well. Like with the rise of, and I know most of our members probably not going to be honest when I say this, use of OpenAI and ChatGPT and all the technology that's been out there in the past, there was this specifically going to time. What role does technology play in modern wealth management? And how has it transformed the way you advise clients? And even I'll add on my question to that. Do you personally feel like AI will replace wealth managers, or do you feel like you still need a human interaction?
Yeah, I think, it's a huge part. And as you can imagine, at every firm, whether it's accounting, it's the big buzzword in what are we doing? We invest a lot of money in our technology and try to simplify tasks and automate tasks. I think eventually tax law, investment logic and thesis is, something that sets up very well for machine learning. I think that's eventually it's going to have to be embraced. Otherwise, manual processes can't keep up. I would say in the tax world, right now there's a lot of antiquated processes, from banks reporting income, the IRS accepting income, consolidating it. There isn't as much uniformity as you would think, and common sense would tell you there should be. There are a lot of things that should be push button, and a tax return. All this information is coming from different banks, different payroll companies. There is a way to make it all flow automatically and remove the need for a tax preparer. Whether that'll happen in my lifetime, knowing how slow the industry has been, I don't know. But I will say, even in every year we make drastic improvements on how we're relying on technology. And from an investment, there's always going to be, unless that AI is asking all the questions that a good advisor would ask, where's your daughter planning on going to college? State school, private school, what kind of retirement do you want? So unless there are going to be robust questionnaires that could cover every logical, there's still going to be need for the human element. But I think you would be naive to think that, technology isn't going to take a greater role in the future.
So Tom, this is my next question, which is, can you discuss the importance of having a long-term financial plan and how it contributes to effective wealth management?
Yeah, I think I touched on that a little bit, just on where I've seen, success is people that stay the course, and they, when they have panic, they're not selling everything or starting new schemes every day. To shift it back to tax, because, that's the area I play in. It's critical. I mean, long-term, because short-term tax savings are much harder to come upon than long-term strategy. And if you can put a long-term strategy where your income is timed properly and you're shifting assets before it's too late, you can really, really create family legacies. And wherever you stand politically, you may agree and not agree with it. Within the tax law, there's opportunity to move billions of dollars of wealth to your heirs and create a family legacy. And until the rules change, people are going to be doing that. And you can't start those plans when you've already amassed the wealth. You need to think of it as you're amassing the wealth and over the course of your life. So it's never too early to start thinking about your wealth plan.
So next question comes from Bailey. How do you approach risk management and investment proposals? What strategies do you recommend in mitigating potential loss, or even, I think, in everyone's best case, to avoid it at all costs? Yeah, and again, I don't want to give this is a perfect example. This is when I would say I'm limited to tax advice. I think, there's nothing I'm going to say that wouldn't, come out of Finance 101 here, of just diversification and, not giving into the scheme of the day. But I wouldn't say from a risk, when I hear risk management, I think of an accounting risk management of how do we, make sure that people are playing within the rules and not trying to do anything that would be considered a tax avoidance scheme. Yeah. So next question comes from Kat. Oh, this was a pretty good question. Could you share your thoughts on sustainable investing and how it aligns with wealth management goals, particularly for clients who prioritize the social or environmental impact? And funny, you just add on to that. Obviously, I think we asked this question a couple times this semester, and it hasn't been interesting responding to those questions, because I have been learning about ESG investing a little bit. It's kind of interesting, but do you feel do you feel like ESG investing will play a big role in wealth management? Or do you just feel like it's just a fad? It's just it's one past it's a fad, on to the next thing. Yeah, I wouldn't call it a fad. I would call it something that has really gained traction and brought in a lot of really, really good minds, people who have left your traditional institutions to form funds or investments that are more ESG focused. And I think that it's, as far as raising capital, it's very important to be focused on, because if you have there are a lot of
investors, pension funds, and the big money that if it's important and it's a mandate that they need to give their money to ESG efforts. So I would not call it a fad in any way. I would say there are a lot of really good investments out there in ESG. But there's also a lot of really good investments outside of ESG. So again, this is a qualified statement. I wouldn't make investments solely upon that, but it's certainly a factor that people are looking at.
Next question comes from Ricky. What are your insights on the role of alternative investments such as real estate, private equity, and cryptocurrency in a well-rounded management? I even funny enough, I think we asked one person last week, Edward jumped about it, and they're like, oh, it's New York life, and he's like, oh, we were not doing cryptocurrency, we're that's it, it's just way too risky. It's not subject, because obviously, like I've even asked the question myself, some of our speakers, and they're like, oh, I get one about it, and it's so regulated, like it's just so complex, like, but yeah.
And I've seen firsthand clients that in 2021 had 9-figure gains from crypto funds, and then in 2022 had 9-figure losses from crypto funds. So if I personally, I'm happy to say, I'm honest to say that I don't fully understand all of cryptocurrency. I understand the taxation of it. I understand the basic principles of it, but the people I know that I'm friendly with that invest in it, they also bet on sports. So that's kind of my personal opinion. I know there's great value in the technology, and I don't think it's going anywhere, but I think some of the coins that are swinging so volatilely, there's a reason they're swinging like that. It's very speculative. Alternative investment, private equity it's a monster. And I think as people get more affluent and they meet the minimum investment requirements for private equity funds, which is oftentimes, they'll require either $100,000 or $500,000 commitment into these funds. It's a great investment. It gives you access to some of the deals and some of the kind of upside that you can't get through the stock market. Ties up your money for a long time. It's usually 7 to 10 year life span of the fund. So your common investors aren't getting into it as much, but it's absolutely, I think you see the people who have done very well in private equity, and the amount of pension funds and retirement plans that are willing to put the bulk of their money into these funds.
So the next question comes from Daniel. Can you discuss the importance, I think you probably mentioned in your presentation, but if you would kind of reiterate, discuss the importance of estate planning and wealth management and some key considerations to creating a comprehensive plan that safeguards one's legacy.
Yeah, the most important thing is to start relatively early. You can, that same $13 million that you get exempt from your estate tax can be used during your lifetime. So that's the gift and estate taxes tied together. So a good investment advisor will start looking early in the wealth building process and say, maybe we should put some of this into trust to grow over time, because that 13 million, if you move it when you're 40 years old, is a lot different than 13 million when you move it when you're 70 years old. So estate planning is something that needs to be done early and looked after often. And then the investment mix, there's investments that make more sense in a trust versus more sense to be, held by you directly. So, I wouldn't be able, I can't stress enough how important it is, especially when you're dealing with a really affluent population. And a lot of the decisions you make with a trust and estate plan are irrevocable. So they shouldn't be done on a whim. There are, you can use like LegalZoom and go online and create a trust. I wouldn't necessarily recommend that. I would recommend going to a really reputable attorney and sitting down and talking through all your wishes. And this is what I want to accomplish. I want a wing in a building named after me one day, versus I want my children to never have to work a day in their life. Everyone has a different goal.
Yeah, absolutely. Next question comes from Julia. what role does philanthropy play in wealth management? How can high net worth individuals effectively incorporate charitable giving into their financial strategies?
A lot of ways. There's, your simplest way is I want to give cash to a charity, stock to a charity, and when should I do that to make sure you're getting the most tax advantage of that donation. There are vehicles where you can contribute a lot up at once. A donor advised fund is a vehicle where there are certain banks and institutions that run them where they consolidate. You can give them $1 million today, treat it as a charitable deduction today, but they'll disperse your money over time to the charities. So a lot of times you'll see someone selling a business or having a very large income event one year. And they want to give to charity, but they don't want to give it all away. They want to be able to go to the dinners and the galas every year for a while. So they'll give to these donor advised funds and match that big donation with a big income year. With the extremely wealthy, you get into the private foundations, and these are tax exempt entities where once you've given to your foundation, if it's invested correctly, the foundation doesn't pay tax. So they can either build a legacy where there's a foundation that outlives them, or some people just like to have a foundation for privacy reasons. A lot of people like to give away money and not receive the recognition. So you can name your foundation anything you want, and you get a little bit of, a little bit of privacy. And then finally, part of the estate plan. You can direct the bulk of your estate to go to charity at death. You can set it up so you have a trust that gives to charity over time and then deposits a remainder to your children. So it's really endless, but it's very important. And I think working with the advisors, once I've kind of figured out how much, working with the advisors to determine what to donate is a common interaction.
So next question, our very own secretary, treasurer of the VA, that's another club. 21 club. How does behavioral biases affect investment decisions? What strategy can be employed to minimize their impact on wealth management?
Yeah, and I think crypto is a kind of a current, a get rich quick mentality. So, again, this is one of those where I don't have much meaningful to add to the conversation, but I do think, if you get in love with a sector or the idea of getting rich quickly, I think if you look at a long enough term graph, there aren't many people who have timed the market many times or timed every fad and gotten into it. So I would say diverse and conservative investing is what I would preach.
Next question comes from Kenneth. Could you share your perspective on the importance of international diversification in wealth management and the potential benefit of investing in emerging markets besides the United States, obviously?
Yeah, we see it a lot from a tax perspective. It gets tricky, but that's another example of things that we like to deal with our clients. There's no secret that it's a global world right now, and limiting yourself to just investments in the United States or just South America, that gets back to the whole diversification issue. There are certainly some markets that you would want to shy away from versus others, but I think you have to look at the global landscape now when you're making investments.
Next question comes from Madison. How has the role of, as a tax advisor evolved over the years, and what new skills and expertise are required to meet the client's changing needs?
I think the thing it's not even unique to tax, it's just the complexity. I think if you go back to when the stock exchange was created, people bought single stocks. You held a stock with the actual certificate, and at some point you either sold it, you collect your dividends. And then, all of these different alternatives and products come out, and it's just brand new products that you have to vet their viability. And that's, whether it's when private equity came out, and now you could pool money and buy companies and share in the upside of that. And cryptocurrency is a great thing. So it's just the amount of products, and, from a diligence perspective, asset-backed, loan-backed securities, like who would have thought that a product that Goldman was putting together and marketing as a riskless product, when you peel the layers back, was actually a toxic investment. So I think now that people had that experience of 2008 and are a little bit more skeptical, there's a little more scrutiny on investments, but there's still just so many products coming out every year that you have to be mindful and keep up to date.
Yeah, so the next question we got here is from Madison. How do you stay up to date with the latest financial trends and market changes? And how do you incorporate these insights into your wealth management strategies?
Yeah, I think this is kind of across all the different types of advisors. Is every firm, ours included, does a really good job of having people who are either on the hill or piped in, and it's their job to stay up to date and put out news flashes and highlights and hosts trainings, whether they be CPE or CLE for attorneys, but trainings to stay up to date. And it's as you build those relationships, like I get news blasts from Morgan Stanley and Raymond James, where they'll say their market insights every quarter. And likewise, we publish our tax blasts when something's either a rumor or something's going to happen. And for the things that actually matter to you, then you just have to read and do your research and make sure that you're reading reputable source material and not necessarily allowing yourself to go down the Twitter wormholes of things.
Yeah, I think we got our next question we got from our Zoom audience. I think Joseph has a question. First, you want to give yourself an ask a question.
Hi. Can you discuss the significance of tax-efficient investing and some strategies that can help investors minimize their tax burden while preserving their wealth?
You were muted up until the last 5 or 6 words. If you don't mind starting that one again.
Sure. Can you hear me now?
Yep, you're good now.
Do you mind discussing the significance of tax-efficient investing and some strategies that can help investors minimize their tax burden while preserving their wealth?
Yeah, absolutely. So I think, and a lot of it kind of depends on strategy and wealth level. I think, from your common investor, it's really market churn and making sure that you're not creating unnecessary taxable gains that are just a byproduct of maybe over trading or, being able to time your gains with your losses. I think that's your most traditional kind of buy-in, that if your advisor is not doing that, there's something wrong. From an interest perspective, making sure that you're investing tax efficient. US Treasuries right now are actually attractive again, given how high the interest rates are, and they're not taxable in your resident state or any state. So, that's an efficient way. Municipal bonds. And then once you start getting into some of the more, I guess, higher entry point investments like the private equities, and there's what's called master limited partnerships, where allow you to invest in a mega partnership that invests. Usually they're in oil and gas types investments, but there are ways through the partnership structure where you can treat your return of capital versus taxable. So the answer is, in short, that from your traditional stocks, bonds, as a investment advisor, I think the buy-in expectation is that you're educated and sophisticated enough to do the basic planning. And then as you get into more complex investing, real estate, that you're bringing in the right people and having those conversations, because it's very hard to unwind decisions, but it's relatively easy to plan ahead and make sure that you're owning things tax efficiently.
Yeah. So
Thank you.
Sure.
Thank you, Joe. All right, our last question on this list here comes from JD. As the wealth management landscape continues to evolve, what challenges and opportunities do you see for both investors and professionals?
Yeah, I think you really hit on it with the question about AI and technology. And I think there's, especially with, the younger generations, there's an expectation especially when you're paying for a service that seems very well like it could be automated. Am I getting that value? So I think it's both my industry, wealth management, legal, it's going to be very important to really show creativity and your worth, because when you're talking about someone's money, I'm in the unfortunate position where I often have to tell someone to make a large payment to the IRS and then send them my bill. From an investment advisor perspective, in theory, you should be making them a lot of money and asking for a percentage of it, but being able to justify that and coming up with creative, helpful ideas is key.
Yeah. Well, that's all the questions I got from this, from our student athletes. I thank them for writing up this list of questions for us. So now I will ask, if we have one more question, that's the final question. We usually ask this question all our speakers. And it's kind of like a two-parter. So the first one is basically, if you had to go back in time, your past to look back in college, what would be the one thing you tell yourself you want to do better? And the second part of that question is, I do in this club, we do a lot of like undergraduate members, like freshmen, sophomores, who haven't really like decided if they're going to go down wealth management or accounting or tax. But what would be the one advice you want to give them? If they're kind of leading toward maybe doing wealth management, maybe doing accounting and tax, like what would be your advice?
Yeah, I think the advice I give people the most is go have an open mind and figure it out. Because when I was in undergrad, I didn't know what I wanted to do. I went to University of Connecticut and I got into the School of Business knowing I wanted to do something in business. It wasn't until after my sophomore year that my advisor said, either accounting or finance, those will get you a job, kind of thing. And I went the accounting route, and out of college, before I even got into public accounting, I worked in the corporate world. I worked for Cigna Corporation doing SEC reporting. Did that very briefly before, or relatively briefly before learning it wasn't for me. So then I pivoted and I went and I joined a tax firm doing tax, and I found out this is something I really like. I got to an inflection point in my career where I thought I want to try a family office because that's something that interests me, and ultimately found out that, I preferred being on the other side of the fence. So I guess the moral of that story, I could very easily say, if I went back to college and, knew now what I know now, that I'm going to be a partner in private wealth tax, would I just focus on that? And I think the answer is no. I think the answer is try different things. If you have the opportunity to do multiple internships in completely different things, there are very few people that go to college knowing this is what I want to do. And all skills that I built along both college and my career are transferable. So, spending a year in audit and then going to tax, you're building a lot of skills in audit that are going to be useful in tax. Being a financial advisor and then saying, I want to be a lawyer, you're just building a broader foundation of skills that are going to help you in the long run. So that's really my advice is don't feel the need to figure everything out at once. Just, take on challenges and do things that aren't comfortable.
Yeah. All right. Well, thank you so much for coming to speak to us today. We really appreciate all the great advice you gave us, all the best things you talked about. Again, members, please stay behind with a couple announcements to make. But yeah, that's it. Thank you so much.
Thank you for all the questions. I appreciate it. It makes it a lot easier.